Everyone, I'm going to show how you can debunk the bear narrative just by drawing horizontal lines corresponding to macroeconomic events that have happened since COVID. Okay, let's get started. So, starting from when the Fed stepped in as lender of last resort, we're going back to September of 2019. Now, to be exact, I believe it was the 17th. I'm just going off of memory here. But, nope, not right now. 17th, Fed steps in. Okay. This is when the Fed steps in, right here. We're going to go ahead and make this bigger. That's what she said. And let's mark this here with Fed steps in as lender, where they have been ever since. Okay, so we're going to change this to red. Okay, so Fed's now lending in the repo market, or, repo market, treasury market, fixed income market, which is where the FICC actually clears, who the vendor for them is the Bank of New York Mellon. So it's all connected, all in cahoots. But we all knew that already. That's no surprise. So what do we see here? Fed steps in as lender of last resort. You see markets start to very weakly trend upwards until around February of 2020. This is when the interfund lending market was basically dying. Money market funds were basically dying. They needed lower rates. Rates were beginning to lower. This is when the Fed comes in to lower the rates. And after doing so, and stepping in as the lender of last resort, they implement the policy, what is known as the supplemental leverage ratio. Now, what this did is it allowed basically the biggest players in the market, Vanguard, BlackRock, Fidelity, to buy up everything under the sun and then lend it out through the repo market and the share lending market. The share lending market is a big ecosystem. I would suggest looking into it because it's a very, very complex ecosystem, but it's not impossible to understand, and it goes hand in hand with the repo market, and there's multiple facets to each of them. But we're going to keep it simple for this video. So the Fed steps in as lender of last resort. The relief basically is implemented right here at, let's just go ahead and put March of 2020 when the bottom of this trend hits. We're going to mark this line with a yellow and we're going to label it SLR, supplemental leverage ratio. Frees up bank capital and allows continued lending. Save that, put it right there. Okay, so next we have a dividend. And I guess I already marked the candle, but what do you notice about that dividend date? This is the first dividend, well, second dividend since the Fed steps in, but it marked the bottom of the COVID downtrend. Exactly, almost. It was a day before the bottom. So SEC relief is implemented as well on top of this, and the SEC relief specifically allows interfund lending between ETFs. So it allows that's why when you go in Fintel and things like that, that's why you see ETFs, inside of mutual funds, inside of index funds, because that was allowed by the SEC in 2020, right alongside SLR. You can look all this stuff up. It's easily verifiable via the internet, the place where most people like to spend their time anyway. So we're going to mark the purple one with SEC relief. And we're going to bring it back just a little bit because these happened very, very close together. Unlock this real quick. Put this right here. I want to say the SEC relief came first. I'm not 100% on that going off of pure memory, but actually, no, I think it's actually after. It was slightly after. SEC relief, and then allowed ETFs to lend to themselves. So BlackRock could lend to BlackRock, basically, which they were doing already, but now they can do it within their own issuance. So we have this, and then we have a great year. Everything is fantastic. Everyone starts to trade. Robinhood, Webull advertisements start going everywhere. Everyone starts jumping into the market. Oil, Gush, all your big names. Everyone's a badass at trading. Everything's going fantastically. And then what happens? Well, right around August of 2020, China implements their 3 red lines policy, which is basically a deleveraging, forced deleveraging. You can look this up as well. It's all online. 3 red lines policy implemented August of 2020 by China. And again, forced deleveraging of the real estate developers. Now, forced. And the reasoning behind this, why they did it at the time that they did it during this COVID outbreak and all this other stuff, is because they were looking to capture a re-rating opportunity. 3 red lines policy, China. Re-rating opportunity. Beneficial for the big players, pushes the medium to small players out, as it always does. That's implemented there. So think about this. At the same time, let's go over to the MCHI real quick. At the same time, in August 2020, this is the China side here. This is the MCHI that tracks China. At the same time, they're forcibly deleveraging, and then the US side is leveraging with SLR and everything else that they had from the SEC. So this continues up until about when? Basically, the beginning of 2022. Because even in January of 2021, when all the apes were born and the whole GameStop fiasco and everything began to surface, we were still trending upwards. We had 2 moments in time where we dipped a little bit, late 2020. But look what happened then. Another dividend marks a near bottom of the trend. So, I mean, when the Fed's in here as lender of last resort, the conventional way of thinking in the market is gone. You have to read the policy and figure out what they're doing, because they're doing specific things. So where are we at now? So let's just refresh where we've been so far. So September of 2019, the Fed steps in. COVID outbreaks are everywhere, and lockdowns are starting in China and all that good stuff. And then in the United States, in January, February, everyone starts to get sick, and more people are getting it. The numbers are going up, and then we go into our own lockdowns by March, and then into April, and that's when all of this stuff was implemented. Then we have a nice ass year for the market. We had all-time highs. Everything's gravy. Roll into 2021. Apes are born. Everyone's a trader. Everyone's bullish. Everyone wants to go to the moon. Everyone's jacked in, and crime. Everything's crime. Everything's synthetic. Everything's fake. No one knows how the market works. That's the problem. But anyways, that's what happened in 2021. Basically, not much happened here other than we had in April 2021, the repo market started to take and receive volume, like a lot of it. Like, it began to break historic records shortly thereafter, but it started its general trend up right around the beginning of April or the end of March. Now, what's the significance about this? Repo market 2021 starts to surge. Now, what's the reasoning for this? Well, remember that policy we talked about over here? The yellow one, supplemental leverage ratio, that frees up the bank capital and allows continued lending to medium and smaller players that are considered risky. But, since the rates are all fucked up and the Fed's lowering them still further, they almost dropped negative. They may have actually briefly for a moment. But rates are lower, everything's going up in the market. Until when? The end of March 2021, when the supplemental leverage ratio expired. So as soon as the supplemental leverage ratio expires, the leveraged lending basically, then all of a sudden the repo market starts to surge. And the short interest for the SPY and things like that, it literally inverses with the Fed's balance sheet at the same moment in time. As all this is happening. And then don't forget, you still have the 3 red lines policy that is currently active on the other side from China. So the repo takes over in 2021, starts to surge right around April, and then that's right around the time that Mr. Gary Gensler got sworn into office on a Saturday, mind you. First time since Watergate that's happened. And, that he became the face of the SEC. And since then, basically nothing's been accomplished other than helping with the cover-up. Now, from 2021 to the end of 2021 is from that moment, repo starts to surge. Rates were risen for the first time in July, which sent the repo market skyrocketing even further. Now, the supplemental leverage ratio is over. The three red lines policy is still on. But there's something new that's about to be added on top of the mix, and that is the new changes out of the net stable funding ratio that were passed or implemented, or not implemented, but they were drafted over the 4th of July weekend in July. And then, at the same month, Fidelity becomes an agent lender in the repo, and then the Fed starts to utilize the standing repo facility, or the SRF, which is a backstop to the repo market. So you can see this shit's getting layered and layered and layered. More and more and more shit's starting to go on. I'm not gonna mark when Gary comes into office because he's like a non-factor. He they just contribute to the relief and all that good stuff. Okay, so here we have the NSFR. I'm running out of colors here. And that's the net stable funding ratio. Basically what it does is it's secured lending, because LIBOR to SOFR is another thing that's on top of all of this. It started before COVID, but we're just talking about COVID here. It's all LIBOR related, right? That's the big deal. It's LIBOR. LIBOR. Net stable funding ratio, July 4th, 2021. I'll mark this dark red. And then standing repos right here. Standing repo backstop to repo. So at this point, you can already see this shit that you've been seeing, in the markets. It's not chaos. It's controlled chaos. It's a huge difference. So at this point in time, the markets, basically dipped big time because of the money market fund issue and rates in early 2020. Then the Fed, started implementing their policy, and then boom, we had a fantastic year and a half, 2 years. Then what happens? Okay, so we start having the debt crisis and debt ceiling scare, like right around the beginning of, September. And that's when DRS was born, and Marco Metzler comes out of nowhere, and all these people start saying, the market's going to crash, China's going to, be the reason for it. The supply chain starts getting messed up. Everything starts getting chaotic right here. And on top of this, mind you, the short interest in the market is starting to increase big time, and inflation is doing nothing but increasing because it's directly tied to the repo demand that you see. And right around the first of the year, literally, like right damn near it, right there, we start to enter our bear market. Everything's going down. Oh no, we're going to crash. Oh no, we're back at COVID levels. And then Michael Burry's got to add up to it and stir the pot on social media. No one knows what the fuck's going on because they haven't been following all these layers and layers and layers and layers of policy that have been going on. Now, another important thing is, remember that 3 red lines policy? Well, guess when that shit ended? January 28th. That's when that stopped. And we had a nice few days there. And then all of a sudden, since then, the Fed's been doing nothing but saying, we're going to reduce the balance sheet. We're going to reduce the balance sheet. But inflation keeps going up. Why is that? Because the repo has still been going up. That is why. So all you have to do to look at inflation and what is going on with it is, where's the repo at? Is it more than it was last month? If it is, inflation's not down. Guaranteed. They're redefining how recessions are defined. They're redefining how CPI is even calculated. They just came out with a 5-year mandatory statute. The SEC has a mandatory statute every 5 years where they have to change the CPI calculation for some of the crowdfunding and shit like that. So this shit, it all works a certain way. The stuff that people think is crime is misperceived as crime because it's something they don't understand, and it has underlying rules that they haven't bothered to look into. And again, another dividend bottom right here, Nancy Pelosi, on June 17th of 2022. So basically, you see that this is calculated, and it's calculated for a reason. There's a lot of things that go into this. There's a lot of layers that go into this. No one person is going to be able to call or be able to basically tell what's going to happen on a micro scale. That's why I like to look at things on a bigger picture. You can consistently see dividends marking the bottoms of trends. You can consistently see the market here during a leverage period go up because it was a leverage period. That was a bullshit run. So we had to cool off, price discover, and we landed right around here. This is the near bottom. Now, do I expect a recession later on? Yes, because this is how rate hikes work. If you look at historics, the rate hike, typically speaking, the early bull was what they call it, is typically tech. But this time around, it's different. It's not tech. It was energy. And if you swap the early bull and the late bull from the previous rate hike cycle, it's the same shit except energy and tech has been swapped, and that's all there is to it. And again, what do you notice about this chart? Inflation has gone up between, let me just draw a line here. These big lines are going to be the inflation lines. Big purple. And you gotta understand, I'm also like, I'm retarded, but it's just not hard to see. Inflation has been doing nothing but going up from the purple line to the other purple line. So if we know that this inflation here was directly correlated with real world inflation and likely to the repo because they stuffed everything in it, which I've seen, and the data is there for anyone to look at. Student loans, bridges, airports, highways, schools, whatever you name. The Treasury of the U.S., of New Jersey, of Ohio, of Canada. I mean, you've all seen it. It's all in there. It's all coming from the same place in the same Interfund lended ETFs. It's all connected and it's allowed to be. And, it's all been about separating the bad collateral from the good collateral and then cleaning it all up. This is Operation Cleanup, and that's all it's been. The market can't crash. Sorry, it's what all these people got their inheritance from. It's where they get their income from. Most of them, their wealth is built on it. It's not going to crash. There's just going to be opportunity to make money both ways at all times. You just gotta find them. As the market's going up, I love it. I fucking love it. But yeah, I mean, the perma bears out there, stop playing the media note. It's not there. The media doesn't know. They just tell you what their higher ups tell them to tell you. They don't care. They just go to work every day. So, not financial advice, but I'm just saying, let me hear some arguments against this. I mean, all of this stuff. If you look into every one of these things, you can see how they go hand in hand, and they directly correlate with the overall situation at hand. If you look at the weekly, get off the daily, look at the weekly. The DMA is lower, basically, than it was in 2020, right here. I mean, it's it's a story. And then you also have to consider China. China's been in a COVID loop since April, since the Fed was supposed to launch the SFT service. Another aspect of this I forgot to put on the chart because there's so freaking much. I'm going off memory right now. But the SFT was a secured financing transaction that was literally going to take encumbered assets, which was a new definition and created by that net stable funding ratio, which is another thing in here. It's all connected. If you take the net stable funding ratio out of it, none of it works. If you take the three red lines policy out of it, none of it works. If you take, one thing out of this, the whole thing falls apart. It's all relevant to one another. It's just relative to one another. Three red lines went hand in hand with SLR. It was, yin yang. SLR versus three red lines. It's the same thing, but in two different ways on opposite ends. You have one side freeing up bank capital. You have one side restricting bank capital. And then look what you saw today and over the weekend with China. China keeps lowering rates. The United States keeps raising rates. That's what's going on. It's just a factual statement. All this stuff, again, is verifiable to look at yourself, and I would recommend doing it. Highly recommend doing it. I've made videos covering most of this stuff. YouTube just likes to shadow ban because, the algorithms are in control. And that's scary. That's the real scary thing. People want to believe what makes them feel good, not what is actually happening. So, just wanted to share that. But yeah, there's a lot going into it. And the start of it all was the Fed stepping in as the lender of last resort And until they step down, which they've already put the filings out to do, it's clear as day that it is coming. The clearinghouses are about to take back over central clearing, which is exactly what the Fed's doing. Yeah, I mean, get ready. So it's don't ever be a perma anything. The rate hike cycle says that after this last dead cat bounce of historic proportions, because the short interest in the market is insanely high market wide, you've all seen it, then we may enter into some recession territory. But after then, I don't give two shits, because I hopefully won't be in this market, because I'll be so effing rich. Bang my desk. All right, anyways,